You are 24 years old. It is a Friday night. The restaurant is packed. You have been on your feet for 6 hours. Your back hurts, your feet hurt, and the table on section 4 just asked you for extra napkins for the third time. At the end of the night, you count your tips. $180. A good night. And then you think about what happens to that money when tax season comes. The government takes a cut. Same as always, same as it has always been. You work the hardest hours, carry the heaviest trays, smile at people who do not always smile back, and you give a piece of every tip to the IRS. Except this year, that changed. On July 4th, 2025, a new law was signed, and most service workers in America have absolutely no idea it exists. It is called the No Tax on Tips deduction. And if you work in a restaurant, a bar, a hair salon, a hotel, or anywhere that customers leave you a tip, this video is the most important financial thing you will watch this year. Stay until the end, because we are going to walk through exactly what this law does, who qualifies, how much you save, and the one mistake that will cost you the entire benefit. What they never told you about your tips. First, let us talk about what has always happened to your tips. Every dollar you earn in tips, cash, card, or shared from the pool, is income. The IRS has always taxed it the same way they tax a salary. Across America, there are approximately 4 million restaurant servers, 3 million bartenders and bar staff, hundreds of thousands of hotel workers, hairstylists, nail technicians, delivery drivers, valets, golf caddies, and casino workers. Every single one of them has been taxed on their tip income since the day they started working. No deduction, no credit, no recognition that this money came from working harder than most. Until now. The One Big Beautiful Bill Act, signed into law on July 4th, 2025, created something called Section 224, a brand new federal income tax deduction, specifically for tipped workers. For the first time in American history, here is what it does. If you are a single filer, you can deduct up to $12,500 of your tip income from your federal taxable income. If you are married and file jointly, and both of you earn tips, that number goes up to $25,000. That is not a tax credit. That is not a refund. That is money the government simply stops counting as taxable income. For the first time, the tax code is treating your tip income differently from your base wage. And for millions of service workers, that difference is worth thousands of dollars. Key real numbers. What this puts back in your pocket. Let us talk about real money. You are a server. You earn an hourly wage of about $3.50, the federal tipped minimum wage. Your real income comes from tips. Last year, you made $18,000 in tips. Under the old rules, all $18,000 was taxable. Under the new law, $12,500 of it is no longer counted as taxable income. What does that mean in dollars? If you are in the 12% federal tax bracket, which most service workers are, that deduction saves you approximately $1,500 every year for 4 years, $6,000 back in your pocket, not from working more, not from cutting anything out, just from filing correctly. Now, if you are a bartender or a server in a busy city and you earn closer to $30,000 in tips, the deduction maxes out at $12,500, but your saving at the 22% bracket could be $2,750 a year, $11,000 over 4 years. And if you are married and both you and your partner earn tips, your combined deduction can reach $25,000. At the 12% bracket, that is $3,000 a year, $12,000 over the life of this law. This money does not require you to change anything about how you work. It does not require you to hire an accountant. It does not require you to file anything extra beyond your regular tax return. It just requires you to know it exists. The people who are not claiming this deduction are not missing it because they chose to. They are missing it because nobody told them. Do you qualify? And what counts as a tip? Here is where it gets important. Not everyone qualifies, and not everything counts as a tip. The law applies to workers in occupations that the IRS has classified as customarily and regularly receiving tips. The IRS published a list of 68 qualifying occupations. The list includes restaurant servers, bartenders, hotel housekeeping staff, hairstylists and barbers, nail technicians, massage therapists, valets, golf caddies, casino dealers, food delivery drivers, personal trainers, taxi and rideshare drivers. What counts as a tip? Cash tips count, credit card tips count, debit card tips count. Tips distributed through a tip pool count. What does not count? Mandatory service charges do not qualify. You know those automatic 18% gratuities added to large group tables? Those are service charges, not tips. The IRS does not count them. And there is an income limit. If your total modified adjusted gross income, that is everything you earn, not just tips, exceeds $150,000 as a single filer, the deduction starts to phase out. For most service workers, that limit is not a concern. There is also one more critical rule, and this is the rule that will cost you everything if you get it wrong. You must report your tips, every single dollar. If you do not report your tips, you cannot deduct them. The one mistake that kills the entire benefit. Let us talk about the reporting rule, because this is where most people lose. Across the service industry, there is a long-standing habit, especially with cash tips. Not all of them get reported. The logic makes sense. Why would you report income that you are going to be taxed on anyway? If the government takes a piece of it either way, why tell them about every dollar? That logic just became very expensive, because under the new law, you can only deduct tips that you reported. Unreported tips cannot be deducted. The law only protects the income you declared. So here is the new maths. If you report $20,000 in tips, you can deduct up to $12,500. Your tax bill drops by $1,500 or more. If you report $10,000 in tips, even if you actually earned $20,000, you can only deduct $10,000. And the $10,000 you hid from the IRS? They still find it eventually, with penalties. For the first time in your working life, reporting every dollar of your tips is the financially smarter move. And the good news is, starting with the 2026 tax year, your employer is required to report your qualified tips separately on your W-2, which means the paperwork gets easier, not harder. The old version of this job punished you for reporting every dollar. The new version rewards you for it. Same work, different rules. How to actually claim it, step by step. Here is exactly what you need to do. Step 1. Report every tip you received this year, cash, card, or shared from the pool. All of it, every dollar. Keep a simple daily log if your employer does not track it. A note on your phone is enough. Step 2. When you file your federal tax return, look for the tip income deduction. If you use TurboTax, H&R Block, or any major filing software, they will prompt you for this automatically for the 2025 tax year filing. Step 3. If your employer is already tracking your tips on your pay stub, check that the amount matches what you actually received. Starting in 2026, your employer is required to report your qualified tips on a separate line of your W-2. That line is your deduction number. Step 4. This is a federal income tax deduction. You still owe Social Security and Medicare taxes on your tips. You may still owe state income tax depending on where you live. The deduction does not eliminate every tax on tips, but it significantly reduces the biggest one. And step 5, tell the person at your job who does not know about this. Because right now, as you watch this video, millions of service workers in America are filing their taxes without this deduction. Not because they are not eligible, because nobody told them. This law was written for the people who carry the trays, pour the drinks, cut the hair, drive the rides, and make the rooms. The least the system can do is make sure those people know about it. Let us recap what you now know that most service workers do not. The One Big Beautiful Bill Act, signed July 4th, 2025, created a new federal income tax deduction for tipped workers, up to $12,500 for single filers, up to $25,000 for married couples where both partners earn tips. It applies to restaurants, bars, salons, hotels, rideshare, delivery, and 68 officially listed occupations. It runs from the 2025 tax year through 2028. It requires one thing from you: report every tip you receive, every dollar, and it puts potentially thousands of dollars a year back into your pocket without changing a single thing about how you do your job. This video is for educational purposes only and is not tax advice. For your specific situation, speak with a qualified tax professional. A link to the official IRS guidance on this deduction is in the description below. If this is the first time you are hearing about this, send it to every server, bartender, driver, stylist, and hotel worker you know. Because the people who need this information most are the least likely to find it on their own. Subscribe to Capital Explained. Every week, we go inside the financial stories the world hopes you never fully understand. This is Capital Explained. We'll see you in the next one.